Ever think about how people in finance deal with, not knowing what prices will be in the future? Being able to lock in a price today for something you'll buy or sell way down the line.
That's pretty much the core idea, yeah. We're talking about forward commitments.
Right. And that's what we're diving into today.
Exactly. And for you listening, especially if you're prepping for CFA Level 2, getting these concepts down, forwards, futures, swaps, it's really, really important.
It's fundamental stuff.
It is. It's not just about the exam. It's about understanding how risk is managed in the real world.
Okay. So our mission today is to unpack the logic, right? How are these things priced? How are they valued? And especially this carry arbitrage idea.
Yeah, we want to connect the dots on the why. Why are they priced that way?
We'll try to hit those aha moments, but maybe skip getting bogged down in every single formula. You've got your curriculum for that.
Precisely. Understanding the economic thinking behind it all, that's what makes it stick.
Yeah.
It helps you see how it applies, in managing risk or even figuring out market expectations.
Okay, let's get into it. These forward commitments. Maybe start with the basics. Forwards and futures, what are they essentially?
Okay, so a forward contract is basically a private agreement. Two parties decide today they'll trade an asset at some future date at a price they agree on right now. It's tailored.
Custom deal.
Right. Now, futures are similar. They also lock in a future price. But they're different because they usually trade on an exchange.
Ah, so more standardized.
Exactly. Standard contracts plus things like margin accounts and this daily settling up process called mark-to-market makes them less risky in terms of counterparty default.
Got it. So same goal, lock the price, but different mechanisms. And then there are swaps. These sound, a bit more complex.
They can be, yeah. A swap is basically an agreement to exchange a series of cash flows in the future. Think interest payments.
Okay.
Like maybe one side pays a fixed interest rate, the other pays a floating rate, and they swap these payment streams based on some notional amount.
And how do you price that?
Well, the pricing and valuation, it comes down to this idea that you can replicate those swapped cash flows using other instruments, like a portfolio of bonds or forwards.
Interesting. The materials you shared mentioned swaps being used for hedging interest rate risk, obviously, but also for things like asset allocation, using derivatives overlays, and even inferring market expectations.
That's right. For instance, an interest rate swap helps companies lock in borrowing costs, converting floating debt to fixed or vice versa.
Okay.
And things like VIX futures, which track expected market volatility, or inflation swaps. Looking at their prices can give you a sense of what the market collectively thinks might happen next.
So VIX futures up might mean markets expect more turbulence.
Generally, yes, or at least that participants are paying more to hedge against it. And inflation swaps give a market-implied view on future inflation. Not a perfect forecast, but valuable info.
Right. Now, before we get into pricing specifics, the material points out some key assumptions, like you can easily trade the underlying stuff, no transaction costs, short selling is allowed, the risk-free rate. Seems a bit perfect world.
Oh, absolutely. They are simplifications.
Yeah.
In the real world, you have bid-ask spreads, margin costs, maybe limits on short selling.
So why use them?
Because these assumptions let us build the fundamental pricing models based on the idea of no arbitrage. They isolate the core economic relationships. The principle holds even if the real world adds friction.
Okay, that makes sense. Which leads us to carry arbitrage, also called cost of carry or cash and carry. What's the intuition there?
Think about what it costs and what you gain by simply holding an asset over time. That's the carry.
Okay.
Carry arbitrage involves setting up positions in both the asset itself and a forward contract on it. The goal is to exploit any mismatch between the forward price and the spot price, plus the net cost of holding that asset until the forward expires.
Net cost meaning?
Meaning you factor in costs like financing the purchase, storage, insurance. Those are carry costs. And then you factor in benefits like dividends from a stock or interest from a bond. Those are carry benefits.
Got it. So it's the spot price adjusted for the net cost or benefit of holding it. And the big idea is that forward commitments are priced, so you can't make easy, risk-free money doing this. Law of one price.
Exactly that. If a forward contract price drifts away from what this carry arbitrage logic says it should be, you create an arbitrage opportunity.
And people jump on that.
Arbitrageurs do, yes. They'll make trades, buy the asset and sell the forward, or vice versa, to capture that risk-free profit. And their actions push the prices back into alignment. Understanding this mechanism is really key for level 2.
Okay, so let's apply that. How does carry arbitrage actually set the price for a basic forward or futures contract? We've got notation like S0 for spot, F0 for the forward price.
Right. And the key is that the initial forward price, S0, is set so the contract has zero value to both sides when you first enter it.
Makes sense. Otherwise, one side wouldn't agree.
Precisely. Now think about expiration, time t. If you're long, the forward you agreed to buy your payoff is the spot price then, ST, minus the price you locked in, ST.
ST minus F0.
And if you're short agreed to sell, it's the reverse, F0 minus ST.
Yay.
A simple linear payoff.
Okay. So how does carry arbitrage fix F0 at the start?
The core idea is replication. You can create the same economic outcome as holding the underlying asset until time t by buying it today with borrowed funds.
Okay, buy spot with borrowed money.
Right. At time t, you sell the asset at ST to repay the loan, which has grown to the future value of the initial cost, F at D, S0. Now, to make this risk-free, you also sell a forward contract today at F0. This locks in your selling price.
Ah, so you eliminate the price risk of the asset.
Exactly. For there to be no arbitrage profit, the locked-in selling price, S00, must equal the future value of your initial cost, FVS0.
So F0 equals FV0. The forward price just reflects the spot price plus the cost of financing it until expiry.
That's the simplest case, yes. It builds in the time value of money, the cost of carry, which here is just the financing cost.
And if the market price F0 isn't FV0, arbitrage kicks in.
You bet. If F0 is higher than FVS0, what do?
Sell the overpriced forward.
Yes. Sell the forward, borrow S0, buy the asset, hold it. At time t, deliver the asset against the forward, get F0, repay your loan, FVS0. The difference, F0 minus FVS0, is your risk-free profit.
And those selling actions push F0 down.
Towards FVS0. And if F0 is lower than FVS0?
Do the opposite. Buy the cheap forward, short sell the asset now, lend the proceeds.
Perfect. That's called reverse carry arbitrage. At T, you take delivery via the forward. At F0, use the asset to cover your short and collect your loan repayment. Again, risk-free profit. Buying the forward pushes F0 up.
So arbitrageurs are like the market's police force, keeping forward prices tied to the future value of the spot price.
A good way to put it. They enforce that no arbitrage condition.
Okay, that's pricing at the start. But what about valuing an existing forward contract before it expires? Its value isn't zero anymore, right?
Right. Its value changes as the underlying spot price changes and as time passes. The valuation still uses arbitrage logic.
How so?
Imagine you have that long forward contract you entered at FFT. Now, it's sometime T before expiration. The market might be quoting a new forward price, FT, for the same expiration date.
Okay.
The value of your original contract now, VT, is basically the present value of the difference between that current market forward price, FT, and your locked-in price, FF.
So like PV of FT, F0.
Essentially, yes. If the current forward price, FT, is higher than your FT, your long position is worth something positive. If FT is lower, it's worth something negative. You discount that difference back from the expiration date T to today time T.
And the curriculum shows exactly how to do that calculation, the discounting.
Correct. The concept is key.
Yeah.
The value reflects what you'd gain or lose if you effectively closed out your position by taking an opposite forward contract at the current market price. Or you could think of it as comparing the current spot price to the present value of the locked-in forward price. Different ways to see the same value.
Got it. Now let's add complexity. What if the underlying asset generates cash flows while you hold it? Like dividends on a stock or coupon payments on a bond, carry benefits, right?
Exactly. Those are carry benefits. They make holding the asset cheaper or even profitable compared to just financing it.
So how does that affect the forward price, F0?
It lowers it. The forward price needs to reflect the spot price plus all costs minus all benefits of holding the asset until expiration, all taken to their future value. So F0 becomes something like FV S0 plus cost benefits.
So FVS0 minus FB benefits plus FE costs.
That's the logic. For a stock paying a known dividend, D, the forward price F0 would be the future value of the spot price minus the future value of that dividend. FVS0 PVD is another way to look at it.
The dividend reduces the effective cost you need to cover with the forward price.
Precisely. And the timing matters too. A dividend paid earlier gives you more time to reinvest it, so it has a bigger impact, a bigger reduction on F0.
Makes sense. The specifics on calculating that future value of dividends are in the curriculum materials.
Yes, exactly. Same logic applies if there are carry costs, like storage for commodities. Those would increase the forward price. F0 equals FV, SV, S0 plus PV costs.
Okay. What about equity forwards and futures on big indexes like the S&P 500? Lots of stocks, lots of dividends.
Yeah, tracking every discrete dividend gets messy. So for indexes, they often simplify by assuming a continuous dividend yield, like the index is constantly paying out a small percentage.
Ah, okay. Like a continuous leakage of value.
Sort of. And the pricing formula adjusts for that continuous yield. It's often expressed using continuous compounding with E, but the core idea is the same. The forward futures price reflects the spot price adjusted for the risk-free rate and that dividend yield over the contract's life.
But the carry arbitrage principle still underlies it all.
Absolutely. And remember, while pricing logic is similar for forwards and futures, that daily mark-to-market for futures means their value technically resets to zero each day after settlement, even if the underlying economics are tracking the same path.
Right, that's an important practical difference. Okay, let's switch gears to interest rates. Forward rate agreements, FRAs. You mentioned LIBOR is being replaced.
Yes, the world is moving to new reference rates like SOFR, SONIA, etc. But the concept of an FRA remains. It's basically a forward contract on an interest rate.
For a single future period.
Exactly. It lets you lock in the interest rate that will apply to a loan or deposit starting at some point in the future, for a set period after that. Pure interest rate hedging for one specific future interval.
The material uses that X by Y notation, like 3 by 9 FRA. Can you decode that?
Sure. A 3 by 9 FRA means the contract expires in 3 months. That's the X. The underlying interest rate it settles against is the rate for the period starting at expiration and ending at month 9. That's the Y.
So the rate for months 3 through 9, a 6-month rate.
Exactly. It locks in the 6-month rate that will prevail 3 months from now.
And how do you price that? What's the fair fixed rate for the FRA?
Pricing an FRA means finding that fixed rate, let's call it FRA 0, that makes the contract have zero value at the start. You derive this rate from the current yield curve.
Using existing spot rates?
Yes. You need the spot rate out to the FRA's expiration, LH, the rate for X months, and the spot rate out to the end of the underlying rate period, LT, the rate for Y months. The no arbitrage principle implies a forward interest rate between month X and month Y, and that implied forward rate is your equilibrium FRA rate, FRA 0.
The math for that is in the curriculum, I assume?
It is. It ensures you can't lock in a better rate via the FRA than what's already implied by borrowing and lending at current spot rates.
And when the FRA expires, say at month 3?
You compare the actual market rate for that 6-month period, LM, to the locked-in FRA rate. If you were long to the FRA, receive floating, you gain if LM is higher than FRA 0. If short, receive fixed, you gain if LM is lower. The payment is calculated based on the notional principal and the rate difference, usually settled at expiration.
Okay. What about forwards and futures on actual bonds? Fixed income. Sounds tricky with coupons and accrued interest.
It adds layers, definitely. You have to deal with clean versus dirty prices, the quoted price versus the price including accrued interest. And carry arbitrage needs to account for coupon payments received, a carry benefit, during the life of the forward.
Right. The coupon affects your cost of holding the bond.
Exactly. Plus, for bond futures, especially government bond futures, there's often a basket of deliverable bonds. The seller will choose the one that's cheapest for them to deliver.
The cheapest to deliver, or CTD.
Right. And the futures price reflects the expected CTD bond, adjusted by a conversion factor that tries to standardize the different deliverable bonds. The pricing formula becomes a bit more involved, adjusting the standard carry arbitrage model for accrued interest and the CTD option. Again, the curriculum covers the details.
Valuation before maturity would still follow the same PV of price differences concept?
Fundamentally, yes. VT equals PVFT S0. But calculating FT, the current forward price for valuation, involved considering the current spot price of the bond, or likely CTD, accrued interest, and remaining carry cost benefits.
Okay, final category. Swaps. Interest rate, currency, equity swaps. The big picture is exchanging cash flows.
That's the essence. An interest rate swap is like a bundle of FRAs exchanging fixed for floating payments over multiple periods. Currency swaps involve exchanging principal and/or interest in one currency for another. Equity swaps means swapping the return on a stock or index for, say, a fixed interest payment.
Pricing them initially, still aiming for zero value.
Always. For an interest rate swap, the fixed rate, the swap rate, is set so the present value of all the expected floating payments equals the present value of all the fixed payments at initiation. Makes the swap's initial value 0.
How do you figure out the expected floating payments?
Using the forward rates implied by the current yield curve, just like with FRAs.
And currency swaps.
Similar idea. The initial exchange rates and interest rates are set. So the PV of expected payments in one currency equals the PV of expected payments in the other, based on current FX rates and interest rate curves in both currencies. Notionals are usually exchanged at start and end too.
And valuing an existing swap later on.
You basically recalculate the present value of all the remaining cash flows based on current market rates, interest rates, exchange rates, or equity prices, and compare that to the PV of remaining flows based on the original swap terms.
Hmm.
The difference is the swap's current market value.
So if rates have moved favorably for your side of the swap, it has positive value.
Exactly. For example, if you're receiving fixed in an interest rate swap and market rates have fallen since initiation, your swap is now valuable because you're locked into receiving above market rates. The curriculum provides the methodologies, often viewing swaps as equivalent to portfolios of bonds or forwards.
Okay, so wrapping this all up, it really feels like understanding that no arbitrage concept and how carry arbitrage works is the absolute foundation for all of these forwards, futures, swaps.
It truly is. That's the unifying principle. Prevent risk-free profits, and you derive the fair price or value.
The formulas you need for the exam are consequences of that core logic.
Absolutely. Don't just memorize formulas. Understand why they look the way they do. It comes back to replicating payoffs and eliminating arbitrage. If you get the intuition, the formulas make much more sense.
So for you listening, hopefully this gives you that solid conceptual base. The next step is definitely hitting your curriculum for those specific calculation methods and working through examples.
Definitely. And maybe one last thought to leave you with. We've talked a lot about no arbitrage pricing based on somewhat ideal assumptions. But think about the real world. What happens when there are frictions? Transaction costs, borrowing limits, information asymmetry. How might those create small temporary deviations from these theoretical prices? And who might be able to exploit them? That's where deep understanding really pays off.